Hi, good morning, everyone. It's John. I'll be speaking about model risk management of SOFR. We'll start in a few minutes. It's just 9 o'clock here in Brooklyn. All right, why don't we give this one more minute? We'll make it 9:02 here in Brooklyn and we'll start. You very well may be watching this. Clean some schmutz off my screen here. You may well be watching this, at your own time on YouTube. So enjoy that. Thanks for welcoming me into your afternoon, evening, or even weekend. I'm going to share my screen. I should say I have a cat who looks something like that. Well, two cats that together. I don't know about brown eyes. I thought most cats have green eyes. So get off the sofa. I think most of you know that's like the expression in English, like get up, do something, get off the sofa, the couch. All right, here we go. So these talks are called model risk management discussions, which nicely could be pronounced mermaid. And they're associated with a new textbook that I'm writing with Martin Goldberg and Chandrakant Maheshwari called Model Risk Management, a textbook for financial engineers. This is, we're at the point where December 1st, we're going to submit the final versions of 4 or 5 chapters. At the end of the talk, I'll speak about next week's MRMD. It's the final MRMD, but because, and that's because we're submitting text right now, I don't want to run into any intellectual property or other issues. So we're going to then do a different set of talks which are orthogonal to these, but will support these ideas of model risk management. Next week, I'll walk through the book. Yeah, this is just the legal stuff that there are, these are public events. By being in here, you will be recorded, your thoughts and so on Zoom's AI companion. You will be, streamed on YouTube. This is live on YouTube right now, unless you're listening to it as an archive, which is also going to be the case. And then I have a website on Dropbox that a link that I can, I'll put up the slides. There are a few Excel files that I refer to here as well that I did as toy models. They'll all be up there. All right, so this is basically 7 topics in SOFR, and then some ancillary material suffixing what we're doing here, including what I said before, that there's a paradigm change and that I'm going over to something called Storm, a new set of talks. So to begin with, an introduction of how we got here and some reflections on what has been called the LIBOR scandal. LIBOR, at the time of its death, was called the world's most important number, which is a fun expression, of course, for someone who's interested in mathematics. In the United States, for USD transactions, SOFR replaced it. So what is SOFR, and how does it compare with LIBOR? Because it's not exactly the same, so therefore there were some growing pains, there still are. And SOFR has some uniqueness to it, that it's an overnight rate, so therefore one needs to do some transformation to get things like a 3-month, what does 3-month SOFR mean, and so on. That's part 3. Part 4 is looking backwards, that if you had a LIBOR deal, or you may still have one on your books, what do you use for that? Or how do you make a deal now that simulates something like a 3-month LIBOR rate from 2 years ago? There are some other unique aspects about SOFR in section 5 that we'll discuss. And then finally, we get close to talking about the actual models by talking first about the instruments and then about the SOFR models. There's a split, as you can see in section 6 here, between the trading book, which is largely derivatives types of instruments, and the banking book, which is largely cash instruments. All right, so how did we get here? So I think it said the Shah of Iran may have been the impetus in the 70s for the first LIBOR. That's unconfirmed. LIBOR stands for the London Interbank Offered Rate. So a couple of things in that, let's unpack that. Interbank means it's the rate at which banks lend to each other, not to consumers, and they're not borrowing from the government. And basically, it's had a strong presence since the 1980s. Offered, in fixed income, we don't say bid ask, we say bid offer. So this is the offered rate that a lender would offer to you. The bid rate is what you would want from the lender, and there is something called LIBID, which is the opposite of LIBOR. It will surprise no one that LIBID was something that was come up with by 20-something traders in the city of London. But basically, this LIBOR was very important. It was, as I said, the world's most important number, and it was used largely for commercial borrowing and for simple rate products, the latter of which go into the area of derivatives. Now it's gone. Now it's just a legacy rate. The construction of it was to have something that was closer to interbank lending, or perhaps with a spread, closer to consumer lending and some business loans. Simply because it's not borrowing from the government, so therefore it is not backed by the full faith and credit the way, let's say, a treasury, a T-bill rate might be in the US. And the mechanics of it were that for USD LIBOR, that at 11 a.m. London time, the British Bankers Association called around and got indicatives from the banks on how much they would charge if they were loaning money to another bank. The mechanics of that then were that the middle 8 of the 16 in a ranking, that is to say excluding the first and fourth quartiles, were simply averaged arithmetically. So it's what I call a 50% trimmed mean. The main liquidity in LIBOR was in 4 currencies, notably excluding the euro. The euro has still the equivalent of LIBOR as an interbank rate. It polls banks on the continent, meaning Europe ex UK, I think something like 40 banks. There hasn't been any scandal in that. LIBOR was quoted at a number of tenors. The most liquid in these is probably 3-month and 6-month. 3-month primarily. And some examples are these 2 cash products, a floating rate note and a mortgage. We'll talk more about derivatives later. Importantly, it was a term rate, which means that it sets in advance. That is, like it's a 30-year mortgage, it's going to adjust, let's say in 1 year, but at the start of that year what your payment will be at the end of that year. And finally, it was an unsecured rate, that it was not collateralized by anything, the way a mortgage is collateralized clearly, as is an auto loan. They just take away the car or the auto, take away the car or the house if you don't pay. So basically, I don't want to say that much here. I think you know most of this. Eurodollar futures were probably the most common LIBOR product, but swaps were also based on LIBOR. So essentially, the construction of the discount curve was intimately connected with the presence of LIBOR. The types of models of that LIBOR rate were, in the first instance, these affine models, which just modeled the short rate, essentially the instantaneous forward rate. And you could choose from either the Gaussian Hull-White model or the log-normal Black-Karczynski model. And then to model the whole term structure, and therefore to do, let's say, arbitrage-free pricing of zero coupon bonds, some of these models that modeled the whole forward rate were done, some with the variation of stochastic volatility. So just a little bit of terminology here, and apologies if this is very familiar to you, but the valuation of an interest rate product is dependent on two terms, so-called numerator term and a denominator term. Think of it just like the simple sum here, that it's a sum of things that are a function of, we call this the projection rate, RP, projection rate. And then that's the numerator, and then the denominator is where the discounting occurs. So this is, ordinary discounting with annual rates or period rates. That denominator rate is called the discount rate, right? So projection rate RP, discounting rate RD. And when I arrived on the scene at Wall Street in 2000, LIBOR was used both for projection, calculating the instrument value, and for RD, the discount rate. It was also widely believed that LIBOR was something like the credit of a AA or single A borrower. Now, all of these things changed in the great financial crisis. Certainly LIBOR was not anything close to a AA or A credit. Lehman, notably, and many other banks immediately had margin calls, and they couldn't come up with the money, or if they did, they had to borrow heavily overnight. So therefore the discounting was closer to something like the effective federal funds rate, EFFR, which is an overnight rate, and more about that later. So the first of two transitions off LIBOR was simply to change that denominator rate, the discount rate, to an overnight rate, EFFR. But I'm sorry, there's some car honking here, because that's what happens when you live in Brooklyn. So hopefully you can avoid that in the playback or audio. The projection rate, that is the one that defines the numerator of these payments, still remained LIBOR. Just to show graphically what happened to LIBOR and how it became something whose spread really blew out. One measure is what's called the TED spread, which is the Treasury Eurodollar futures spread. And you can see from 1986, which is probably before when many of you were born, to 2006, except for this period of very high inflation in the 80s and some other events, largely this TED spread was between 0 and 200 basis points. But in the great financial crisis, it blew out to something like 5%. So that was worrisome, that now LIBOR was really something that was not stable and not stationary at all. And around the same time, the journal, the Wall Street Journal, that is, started reporting that it believed that banks were manipulating LIBOR. And the hypothesis was that a bank whose portfolio was largely short LIBOR would, instead of quoting an indicative rate for what they really would be lending at, they would quote a lower rate so that they could goose up their profits. Correspondingly, a bank that was long LIBOR would manipulate, cheat, whatever verb you want, and round up. Again, the reminder, it's 16 banks, and there's a trimmed mean. Let me just show you what I mean by the trimmed mean explicitly. So you start out with an unsorted set R sub I, then you sort it, that's what the superscript S means, and then you're summing ranks 5 through 12, the middle 8 out of 16. I should say I'm a LIBOR skeptic in the sense that I'm not sure that it was really ever manipulated or that one can show that and prove that to a quant. I understand from a legal basis that there was a lot of planning to manipulate it that can be documented, such as texts and emails. And just like in Washington, D.C., you rarely get prosecuted and convicted of a crime. You get prosecuted for intending to commit a crime or lying about having not committed the crime. Perjury, these other things are a lot easier to prove. And to show that, I made a couple of models. This is the more complicated model. In this case, I have something where I have 16 banks, and the base case, the base use case, if you will, is that they all submit a rate based on a normal distribution with a mean of 3% and standard deviation 2%. The cheaters submit a rate that's one standard deviation larger. And again, I'm sorry about all the sirens and things in the background, so I'll repeat it. Effectively, you're going to allow some of these 16 banks to submit from a distribution that has a mean that's the same standard deviation, but 2 percentage points higher. I'm also assuming for the moment that all the banks are independent, so I don't have to do a Cholesky or whatever. And the trim mean that I'm going to do then is from 250 realizations. So this is a big Monte Carlo. Monte Carlos were covered last week and have been discussed relatively extensively in the MRMD. There's also, so what I did is then I averaged these annual trim, the 250-day trim means for each bank, and then I calculate the standard deviations of those. Standard deviation always turns out to be about a 0.5 percentage point. So these are the results right here. So if everybody was following the law and not cheating, it would be 3% plus or minus 0.5%. That's what this is. The reason it's not exactly 3 is because of measurement error of 250, 1 over square root of 250, which I've covered in other talks. So then as we progress across the graph, we're increasing the number of cheaters who are reporting from a 5% distribution, 5% mean, as opposed to a 3%. So if you look at 3 and look on the error bars, you can see even at 6 cheaters, we are still basically within the error bar of the 3% base case. Why is that? Well, the top 4 you're not going to affect much. I show this later because that's part of the first quartile. And then you start to get it into here, but again, they all have to work together and do it by the same amount. After that, you can see that incrementally you increase a little bit, and so you do get a manipulation. In this case, the manipulation can be, close to that 2%, up to that 5%, if everybody does it, and everybody does it in the same direction. The spreadsheet that I used to develop this model is going to be available on the Dropbox site. Another way to look at that is the difference, the amount that you're changing things for each cheater. For example, it's about 2% overall if they all cheat. But if only 1 or 2 banks cheat, it's pretty small. Right. So basically, I'm sorry, this is better explained in the Excel, but the effects of each bank are small. Let me put it that way. I think I have to update this slide to make it a little clearer. Sorry. Here's another model. In this case, what I do is I take 16 banks and I assign to each of them a rate between 3 and 5, roughly, and then I sort them. So what I'm going to do in the following is to calculate the arithmetic mean, the 50% trimmed mean, and then the differences of those from the base case. So for example, if I just have the top, so now we start to cheat. So the banks at the top, which means the lowest rates from the base case, can, in this experiment, go down to 2%. So that's a manipulation if they were short LIBOR. And the banks at the bottom end, which again means the highest rates, will go up to 6%. So what does that do? Well, as I showed you before, the top 4 banks manipulating will do nothing, and likewise the bottom 4. So what you have to do is you have to get at least 5, 6, 7. Each of these is manipulating the rate by, 5 banks move at 2%, but the net effect on the overall trim mean is only, something like 20 basis points for each, and that's incrementally true. 24, I guess, here, basis points, and closer to 20 here. And again, this is the second of 2 spreadsheets that will be available on the Dropbox site. So this occasioned the second LIBOR transition and many cartoons, such as this one adapting Pinocchio. So the regulators pushed to eliminate LIBOR completely at this point. And one of those things that would be nice mathematically would be to be able to use a new rate and use it both for discounting and projection. Of course, the discounting rate at the time was an overnight rate, and that was effective federal funds. So then we start planning for the death of LIBOR across these 4 currencies and across all the instruments. So one of the requirements was that this new rate not be indicative, but based on actual transactions. The more transactions and the more notional in those transactions, the better. So that it's not set by a bank view, but by an actual transaction that it's doing in the interbank market. That would make it, you also want to make it something that's extremely difficult to manipulate. You can't just report it. And that's when they started coming up with the term risk-free rates. As we know, nothing is completely risk-free. But what they meant is if there's, a series of interest rates in a country, this was something like EFFR that was really the lowest risk, or very close to the lowest risk in a particular country. Risk here meaning the risk of counterparty default. So SOFR, which stands for the Secured Overnight Financing Rate, was developed by the Federal Reserve Bank of New York as one of the several rates candidates that could replace LIBOR. And FRB NY does some other rates as well. I present that later on in the talk. SOFR in particular is the rate from interbank repo transactions between banks, so short-term rate, collateralized by US Treasuries. So it's a secured rate. The Federal Reserve Bank of New York designated an independent commission, the ARC, and that proposed SOFR to replace USD LIBOR. Then there was the so-called LIBOR Law, or LIBOR Act of Congress, which made it the official alternative to LIBOR. Just to go over how it's done, it's basically a volume-weighted median of a particular class of repos, and mine is the U.S. Department of Treasury's Office of Financial Research. That was one of several agencies created by the Dodd-Frank Act. Here's the reference to SOFR, and here are the other rates I referred to on the previous slide. EFFR is also published by the FRB, and some of these other lesser-known rates. SOFR is not something that's set in stone, and in fact, there are some upcoming changes that are coming, in the next 7 days. Here's a side-by-side comparison of SOFR and LIBOR. So SOFR, as we said, is dead, and SOFR is alive and replaced LIBOR, which is dead. So here let's talk about the publisher of the rates, the tenors it's available in, the base rate type, I'll explain more, the collateral, and the transactions underlying it. So I'll just go down the SOFR list, and then I'll compare it to LIBOR. We know the publisher. I already said that, or I'll reemphasize that SOFR is just an overnight rate, whereas the, if you will, the infinite foresight of the British Bankers Association somehow could quote tenors for future payment across 3 months, 6 months, 1 year. So you don't have that, and these are indicative, remember. So therefore, the basic rate in LIBOR is a term rate, it's a forward. The basic rate in SOFR is backward, that it's the previous day. Collateral we spoke about, and then the transaction base of these repo transactions is huge. These are the largest banks in the world primarily, and so it's definitely transaction driven. The tenors are a bit of a problem. The fact that the SOFR rate is, I call this ON for overnight, R sub I. R sub I means, the ith day, because it's a daily rate. It's quoted after the market closes. But people in the industry generally would want, well, a term rate and a term rate of a particular tenor of 6 months, 3 months, so on. We can't immediately go to a term rate. The original conception of SOFR was that it was backward. And that means that if there is a tenor, you're averaging over past history. I'll talk about the mechanics of how you could use that, but largely this backward method is what people use. That is, the derivatives markets use it because they understand that there are modifications that can be made so that these are not, suddenly something you reach at the end of the period, but in some sense it's known in advance. The two ways I'd like you to think about that are what's called the simple rate, which is used for a 1 month future for SOFR, and the compounding rate. So this is an arithmetic mean, and this is essentially a geometric mean. Now from these, other vendors using a published model of the Federal Open Market Committee's actions has backed into term rates up to 1 year. I'll talk about that later. Here's just some of the particulars of working with one of these backward rates. So, the worst case scenario is that you have a payment due in 3 months and you find out on the day that it's due, right? So that's kind of unkind and could produce counterparty risk. So there are 3 ways that this has been worked around. There's no official way and there's no universal adoption. But one of them is simply to use a prior period. So as I say here, let's say a payment is due at the end of November for a 30-day obligation. So we could actually compute it on October 31st and always be talking about the rate from a month ago. That, of course, has some timing adjustments. Some people would say convexity. We call it a timing adjustment. But you can correct for some of those things. The other 2, basically, B and C here, it's in advance, but in advance just by a few days before the payment. So one way to do that is to lock out. So if it's supposed to be a rate based on 30 days, you stop at 25 days and report the rate, and then the person pays that at the end of the period. So they have 5 days to adjust. And a sort of similar way to do that is just to say that after day 25, it's frozen at that rate. As far as the term rate model, the first reference here from the Federal Reserve is, essentially, as they say, a possible path of overnight rates consistent with FOMC actions. And so, for example, in the CME, Chicago Mercantile Exchange, lists 1 month and 3 month futures, and then it uses those prices to itself issue a term SOFR based on the Fed methodology. It does that in 4 different tenors. And if you're curious why it doesn't also use swaps, it's, first of all, SOFR swaps for fixed float are not really available. And the ones that are, these OIS swaps, which I'll explain to later, are just not very liquid. They certainly don't trade on anything like the Dodd-Frank swap execution facilities or recent things, whereas the futures are up there. Futures, again, are echoing what used to be the LIBOR Eurodollar futures. Now, having constructed this rate, then we immediately say, well, we don't really want too many people to use this. Why is that? Well, term SOFR, as I've explained, requires the simple rate for the 1 month and the compound rate for the 3 months. So as a thought experiment, imagine if if everyone tomorrow decided that they're only going to use term SOFR and they're not going to use the simple and the compounded SOFR that are a backward exercise. Well, then the liquidity in those markets dries up and then term SOFR doesn't mean anything. That's called the inverse pyramid. I think the term was coined by Andrew Bailey of the Bank of England. And so basically, you can only have a small number of people using term SOFR. And in fact, it's primarily used just in cash products. As I indicated before, the derivatives markets have never had really an issue of doing something like the lockout, the freeze, or the in advance. So therefore, derivatives only use simple or compounded SOFR. That's a problem. That means that if you have a term SOFR position like a loan, something like that, there's a basis between term SOFR, an unknown basis between term SOFR and the compounded one. So you're going to go get a swap or a future based on compounded SOFR, and it's not going to completely hedge your term SOFR position. I'll return to some products which might shed some light on those bases. But let me also talk about sort of the reincarnation of LIBOR, how it can still exist in some sense. And this was particularly important in the period, 2022, 2023, just after the end of LIBOR. So the idea is essentially that you could take a legacy LIBOR product that's on your books and come up with a reset rate for it. So again, it's primarily for these cash products. And you have to then know the specific flavor of SOFR. These are called fallback spreads, and are also mentioned in this congressional legislation, what I call the LIBOR bill. So these are used by cash investors and end users in two ways. You can state it to either backward or forward, and within backward you can have a spread to simple SOFR like the 1 month, compound SOFR like the 3 month, or to term SOFR. In the consumer case, you compound only in advance, so that would be from a shift of observation period, or you could use term SOFR. Now you could ask yourself, well, why don't they just use overnight SOFR and compound it? So the scariest thing I found during my work on LIBOR transition is that systems, I believe Loan IQ is one example, take compounded interest as an input, that they are unable to do daily compounding. And since that's something that you're taught in the first semester of any finance curriculum, I just find it shocking that loan management software cannot compound daily interest. But apparently, since it can't, then they want to just read off a LIBOR rate. And now let's go a little bit more into the economic significance of that, because there is a basis between LIBOR and SOFR. That's what these fallbacks show. And I alluded to possible basis between term and the backward rates. So the LIBOR SOFR basis has to take into account a couple of things. First, collateral, and second, credit. So SOFR is an unsecured rate. I should say that some of the other LIBOR replacements, the JPY rate and the UK rate, the sterling rates, are unsecured. They're similar, but they're unsecured. SARN, which is the Swiss rate, is secured, but the Swiss market was always a very small part of LIBOR. Right, so these sort of collateral and credit rates are intertwined, and sometimes the fallback spread is called the credit spread. That's not really right. By the way, another thing that you could do as an alternative would be to use not LIBOR, but something else, like a Maribor, which is sort of a cute idea, but I don't think really ever took flight, is something that's supposed to be based on investment grade, well, just generally on corporate bonds. And so therefore imputing a spread from that. Bonds themselves, of course, don't trade on exchanges, so that's not that easy to do. And I don't know how, I think they also constructed a term LIBOR, a term Ameribor. I mean, it's a cute name though, Ameribor. Bloomberg also constructed something called, I forget what this is called, maybe someone can remind me. But anyway, that's extinct, so that didn't work. Here are the fallback quotes themselves, which would indicate then the joint effects of collateral and credit. And they're available, these are going to be refinitive rates that are published by the London Stock Exchange Group, or published in the sense that they're offered daily. Item one is the adjustment we were talking about. It's an additive add-on. Sorry, in their terminology, adjusted SOFR means the transformation from overnight to either averaging or compounding. The spread adjustment is the basis, and the fallback rate is the sum of those two. And you can see there are different, these are some of the flavors that I had mentioned. You can also floor it because some people don't like the idea of adding a negative spread. Now, one way to try to back out collateral is to look at the relationship between SOFR and EFFR, the effective federal funds rate. Remember, that's something that the Fed also publishes. And in fact, you know, historically, we could look at them and see how close they are, SOFR and EFFR. Ideally, you would have something where SOFR is always a lower rate than EFFR systematically, and that difference would be largely the collateral. You know, EFFR is lending on reserves. It's not exactly the same thing as repo, but they're relatively similar. Now, you can see that there were definitely some periods where the blue is SOFR, where SOFR was very much decoupled from EFFR, but primarily, especially since, I guess since COVID, there's been a pretty good agreement. It may be easier to see that on this side. Here, let me move a couple things around here on my desktop so I can do this better. So here's the SOFR basis and basis points, the SOFR EFFR basis. I cut it so that these, you know, some of the, oh yeah, and the date axis is the same as this, sorry. I've been fighting with Excel, but this is the same date axis. So this point here is that point there. You can see that more recently, you know, that it's been a positive basis, that SOFR has been higher, which, you know, is maybe not what you would expect. But anyway, it seems to be bounded, except in these crazy times, by about plus or minus 10 basis points, this basis. You can also do a regression of SOFR on EFFR. I did that. That's available on a third spreadsheet on the Dropbox site. But, you know, you don't have to be a quant with a PhD to see that if the line is basically a slope of 1 and the intercept is basically 0, that you're not going to learn a lot from this. I quote confidence limits just because I have been somewhat of an evangelist for standard errors. But, you know, I think basically EFFR and SOFR are very similar. And that's actually fairly useful because SOFR was only defined since 2018. So EFFR is also a starting point that you could go back, you know, to essentially 100 years ago and construct what SOFR would have been. Darrell Duffy of Stanford and has focused on an independent trading index, an independent index to measure the credit spread between SOFR and LIBOR. and the mechanics are described in the reference here. But these are the types of things that you see, and they do it both for overnight and for term. I think, as I said before, these are largely going to be the credit products, the cash products where credit is applied, that they're not really going to be used for backward. But you can see, again, the magnitude is as the spread was, or the standard deviation of the spread between FFR and SOFR was about 10 basis points. So it's about 10, 20 basis points. So the next two sections are maybe the heart of the talk. I'm glad to see we still have 20 minutes left in the lecture. At first, I'm going to talk about the instruments, the curve, and then I'm going to talk finally about the models, the formal models, as far as pricing and risk. So there's a dichotomy, as stated before, between the derivatives products, which here I call the trading book products, and the banking book products. The most liquid SOFR products are, as stated, the 1-month average futures and the 3-month compounded futures. There also are some futures options, but and those are on CME as well. I'm not familiar, but I have to think that there's not a lot of open interest or volume in those. The one swap that's out there is one that is an annual swap with conventions from the money market world where overnight rates are common. So one leg of this swap pays fixed at the end of a year, and the other one pays the compounded interest of the overnight rate over the course of the year. I've seen some variations where it's a shorter period, and then you do some sort of compounding up to that point, 6 months or something. But primarily the market is these overnight index swaps, what they call. Similarly, the primary markets in cash are consumer loans, lines of credit, business loans, and mortgages. And they primarily use term SOFR. Now, I have to say, I'm going to spend a little time just talking about how you include these credit spreads. Basically, to cut to the chase, for a 1-month SOFR future, we're dealing with a linear product in the sense that it's arithmetic averaging. And as well known, the mean of a sum is the sum of the means. So averaging the quantity of SOFR plus the spread is equivalent to separately averaging the two, assuming they're published on the same days, et cetera, et cetera. But this should say that the 3-month SOFR future is compounded, and we know that compounding a sum is not the sum of the compoundings, that compounding is a lot closer to being a geometric average. Ideally, there would be some sort of a multiplicative average, like relative AXI, and then you could multiply, so you have SOFR times this effect, which could be the same thing as compounding the sum, but have the effect in a relatively clear way, and be able to decompose it into its separate compoundings, not by arithmetically, but geometrically. Now, how you do this then in general is can be extended to swaps and so on. If it's a fixed float swap, which don't yet really exist and are not really that liquid, then it's the 3-month, which you've already backward compounded, and the 3-month backward compounded AXI, and you take the sum of those two. But in fact, as stated, the OIS swaps, which are the ones with annual compounding, then have the same problem that I noted with the 3-month SOFR futures, that you don't know, it's ambiguous which of the two ways. So for Academy and a PhD from Stanford, I take it, who worked with Duffy on AXI, has imagined that there actually be a market for AXI swaps. So you can isolate AXI and maybe get swaptions and have some idea of what the implied vol of swaptions on AXI might be. The issue there is now there could be at least 5 different ways of backing AXI out. This may be the most interesting because this is basically the compounded SOFR plus AXI minus the compounded SOFR. So that is kind of getting into the weeds on how you're using it. But you can also imagine, just overnight, this is an arithmetic mean, this is geometric or compounding, and this is what with respect to a fixed rate. I discussed before what LIBOR uses for the discount curve. In the case of SOFR, we start with overnight SOFR because that's the only real independent rate, right? These 1 month average and 3 month, the underlying stochastic process is still just the overnight rate. You're just summing them. The compounded one is closer to being, as well a stochastic process because it's the product of those. And then at the long end, we could use the OIS swaps. Okay, we have about 15 minutes left. I think we're fine. Just to say that aspirationally, if you could think of the things that you'd like to have market traded instruments that do these important bases. The most important of which is between compound SOFR of the backward variety and term SOFR of the forward variety. Same thing for simple, and then, a compound simple one, which is not that difficult to do. And that at least is something that could be done analytically or semi-analytically. And then just to say, it would be nice to have a volatility surface, but primarily the swap market being relatively new in SOFR, there isn't much of a swaption surface, let alone a swaption cube, which would incorporate, 3 quantities. There are, I guess, some SOFR caps and floors. Later I'll show how to price one. But primarily the market is futures. Yeah, this just is saying, first of all, that SOFR swaps are less liquid than SOFR futures. And second, how ICE, which has made a commitment to publish these swap rates, would, by a waterfall, estimate what the swap rate should be. There's a reference. So let's get into the models. One sec. So the simplified model that you would think of first would just be a short rate model. And like the Hull-White model. And in this case, you have, or just Vasicek. And that assumes normal rates, which is okay if rates are low. Of course, we just went through a very inflationary period, and I already showed you that SOFR can spike. So that may not be that great. But it's a tractable model, just as Hull-White is, so that you can get closed form solutions for most kinds of derivatives. The SD underneath that is going to be that the rate process for the short rate is equal to a deterministic process plus a stochastic process. And to give a little more flexibility, we make the stochastic process x of t mean reverting. You can see it's reverting to a mean of 0 with a strength of k and a stochastic term. So with that, you can price a caplet. And I want to introduce 2 things. First of all, you may have seen this before, but commonly in fixed income, we change from a money market numeraire, which is in the risk neutral case, to a T forward measure, where the numeraire is the price of a zero coupon bond. PT of T means the price of a zero coupon bond of maturity T, capital T, at price at time little t, that little tongue tie. So then we can talk about the arithmetic average rate, RA. So let's suppose that we have something that's based on that average SOFR and pays a cap on average SOFR. It's relatively straightforward, as shown in the paper, reference at the bottom, that this is essentially the T forward measure expectation of the average rate, positive part of that. This is a day count factor, and this is the zero coupon bond. the reason that people went to more sophisticated models than Hull White, like the Heath-Jarrett Morton model, was because it was understood that, sorry about that, was that the whole forward curve really needs to be modeled because there might be arbitrages. And in this case, we could calibrate so that we're making sure that we're pricing zero coupon bonds directly. So a picture's worth 1,000 words. This is showing over time SOFR, which is the spikier line, as opposed to this piecewise normal, the red line, which is, the actual Fed overnight rate. It's not the same thing as EFFR, but it's the actual one that the FOMC recommends and or establishes. So you can see that could be quick. It fell a lot, obviously, during COVID. But assuming a forward rate, then we can make a term structure model. And essentially, what does that look like? Well, so this is the forward rate, as seen T for maturity capital T. That consists of three terms. The first is the spot rate for a bond of material T. Second, here's another deterministic term as in the previous model for short rates to give flexibility. And then this term here is the sum of essentially the Brownian motions reflecting FOMC activity, right? So some of that's going to be uncertain because we have future FOMC activity. Formally, it's a sum of Brownian motions with these xi I weights. Now, we don't have to include every FOMC date. For example, consider the case of just a two-factor model involving three Fed dates. The Fed dates here, the FOMC dates are X1, X2, and X3 in increasing order. So now let's suppose that today we have not yet reached the first of these three Fed dates and that the maturity of the security is between X2 and X3. Then we can write an expression that has the spot rate, the deterministic piece, something that's dependent just on time, but not necessarily on what's happening at X1. And then something, the second factor, which is dependent on the actions of what happens at X1. How does this model work? Well, they priced SOFR futures. In this case, they priced the M's are monthly futures, which are the arithmetic SOFR, and the Q's are quarterly futures. And this paper then compared it to another paper, Skov and Skovmond. So this is three iterations where, at the beginning you use one factor and you find that the root mean square error, RMSE, for pricing is pretty large. By introducing two factors, you can minimize the number of cases where RMSE is greater than 2.5 basis points. And with three, then you eliminate that and everything's below 2.5 basis points. Note that the published model actually exceeds 2.5 basis points at the shortest maturities. And then the ultimate is to have something like LLM, the LIBOR market model, and that is achieved by what's called the forward market model. There was a funny paper title called Looking Forward to Backward Rates. How does that work? Well, the idea is that we should be able to price all SOFR backward and forward instruments with the same model. And I'll mention completeness a little bit later. A complete model is able to explain all market instruments, and vice versa. The completeness can be, it can be hedged by using all the market instruments. So earlier I talked about the T forward measure. Now I'm going to call the extended T forward measure. What does that mean? That means that a zero coupon bond actually has a life after maturity. At maturity, this PT of T goes to 1. So then let's imagine that it exists even after maturity at times greater than T, as it would for a forward instrument. And Lyashenko and Mercurio then talking about things in terms of the money market account. which has this dynamics. It basically looks like a forward with no drift. Sorry, it's an exponential process with no Brownian motion, no stochastic term. Money market is known. And so therefore, with this, the assertion is that we can price a caplet as we did with the short rate model, but we can price it if it's forward looking or backward looking. Let's just look at this carefully. So you can see that the payoff of maturity in interval T sub j is defined by a rate that was defined at the end of the prior period, Tj minus 1. So this is kind of what you could do with LIBOR before. A full period in advance, you know what the payment will be. This is the arrears one, where you only know the payment at the end of the period or with the adjustments that we spoke about, perhaps close to the end of the period. So as you might expect, well, okay, so then if we think about this in terms of the Black-Scholes model, so now we're assuming log normal rates. I said Black-Scholes, I meant Black 76, as it said here, the model for caps, floors, and swaptions of Black. And that Black model is incorporated here. We have within this a volatility term. The volatility term is simple, as you would expect, for the forward caplet, and but more complex for the backward caplet. Interestingly, the backward caplet is always more valuable than the forward caplet. That's the statement in the paper. I'm not sure I understand it, but that's what it is in the model. I do not know whether that's true in practice. So, and then this forward market model can then produce some interesting closed form expressions. Okay, so let me talk for a little bit. Here's this word cloud that I made before, so you can stare at that. Maybe we can make wallpaper out of that, or toilet paper. Just a little bit on coming attractions. So next week is going to be the last MRMD, and I'm going to do a walkthrough of some parts of our textbook. This is just some aspects of, how we expect to train and how we think that FEs should be trained. Like they should be trained differently, we feel, in the model risk management of pricing as in risk. And then there are a number of other topics, such as governance is something that you see in the model risk world. There are things like AML and fraud. These are particularly amenable to AI. It seems to be superior to rules-based models. We talk about AI and machine learning itself, and we provide Python code and teaching examples. As well, there is a new, what will replace this in December will be STORM, Special Topics of Risk Management. And the first two topics I'm suggesting are securities lending and FX options, things that were not covered strictly by model risk, but have other issues. The Zoom Connect for STORM, the first of which will be on December 4th, is below. And I also created a new STORM discussion group on LinkedIn. So you can join that automatically if certain criteria are met in your profile. Otherwise, I'll approve, submit to me for approval. This is just something on Delta Vega if you want to know what my business is. And this finally is my contact info. So I think I'm going to stop the share so I can check on, first on, let's see, Greg Marpison is here, so he can ask a question. Other people may be on, let me pull up the YouTube. Somewhere in here, someone is watching. Well, that may be me. Okay, so maybe the YouTube will be something that people look at later. All right, well, it's a couple of minutes before 10, but I have time for a quick question or comment. Greg, if you want to chat, or if anyone else wants to talk. maybe you all feel that LIBOR really was manipulated, and that's fair. Even if LIBOR were not manipulated, the fact that it's not based on transactions, but just based on, indicatives, I think is a bad thing. And it's so odd that it was the world's most important number and underlay trillions of dollars of transactions, but was not itself based on anything that was actually observed in the market. And yet, Greg, you can certainly call me, maybe give me a little bit so I can put these materials up for the people in the talk. All right, everyone. So then next week, it's going to be a walkthrough of our model risk management book, and the 28th, been doing this for almost 30 weeks of revealing something about the book. At the moment, it's in good shape. We're just working out things like, why doesn't it read all of our equations and, equations, figures, tables, and so on. But a lot of the content is done. Great. So thanks everyone who's watching this on the archive, who watched it on YouTube, who may have popped into the Zoom meeting and left. Have a great week. And I guess next week will be still prior to Thanksgiving. So there'll be some Thanksgiving